Hi, I'm Laurence Parker-Brown. Welcome to the Inside Network. Welcome to this conversation with the Inside Network, Laurence Parker-Brown and Adam Grotzinger joining us from Neuberger Berman. Welcome.
Thanks. Good to be here.
We've experienced volatility at the start of this year. Is that something that investors should brace themselves for moving forward?
So yeah, in the short term, continue to expect volatility. And I think that's a function of basically central banks at or near the end of their hiking cycle, but ultimately still data dependent. And the data is going to have some kind of volatility to it in the short term. And markets going to trade that. And that's going to induce this kind of ongoing short-term volatility. But I think the good news is, looking out beyond the short term, call it 12 months out, 18 months out from now, I think the clear direction of travel is one of some devolatilization, particularly to the rates markets, as central banks will be at the end of their hiking cycle by then. And inflation is on a clearer trajectory to where central banks want to see it to go. And growth is stabilizing. And so the culmination of those three factors, I think, equates for some devolatilization over the more medium term.
So rates reprice so rapidly. A lot of investors and committees are trying to work out if that was temporary phenomena that they experienced or part of a new regime. What's your view, Adam?
I think the speed and the pace of rate hikes is behind us. So, the good thing is we have slayed the inflation beast. That's kind of our view, that we now have restrictive enough policy with a lagged enough effect that will start with confidence seeing that inflation coming down. So I think, the prospect for another bout of that same degree of rate hikes in that same period of condensed time, very de minimis risk to that. If anything, really think that we're entering this kind of regime of greater stabilization to rates now that we're on that forward-looking trajectory.
So in slaying the beast of inflation, central banks have had to create higher costs for businesses, not least of all with their borrowing. And there's some softness around consumer confidence. It seems logically that would take us to a place where some entities are going to struggle. Is that something we should be across as investors, that there's going to be some creditworthiness challenges?
Yeah, I think that's the prudent mindset and appropriate for the kind of macro landscape that we're in for the next 12, 24 months, which is, credit is starting, corporations are starting from a position of strength. That's the positives, right? The negatives is because of everything you mentioned, that position of strength will be weakened. But the weakening's not going from strength to absolute weakness. We're going back to kind of the long-term averages you've seen on things like interest coverage or kind of EBITDA, debt EBITDA leverage ratios, et cetera. So transitioning to kind of a deterioration of fundamentals, but fundamentals that are kind of more in line with the long-term averages. And I think the net of that all is just brace for more idiosyncratic risk, a little bit fewer or more, I should say, left tail outcomes in corporate credit, and scale yourself and position yourself appropriately for that environment.
So there's a selection criteria that you're applying. Could you run us through that? Because your investable universe is substantial. How do you start to narrow the field and try to build to your portfolio?
Yeah, so the way we think about it is kind of two engines or levers that we need to pull. One is getting our selection right, and that's kind of an ongoing process of having a deep research team that's proactively covering their universe, their issuers, and making assessments and judgments of the forward-looking prospects for their businesses. And are those businesses cheap or rich relative to kind of that risk? So we populate our portfolio according to their views, line by line. But the other part of the process is saying, how much duration risk should we have in a portfolio? What sector we should be putting more capital to work in, and which sector we should be taking money out of in the broader fixed income landscape. And that's a process that goes back 25 years for us. It's a collaborative process with our sector teams. In essence, we're asking two questions. Not only what we think the return prospect is for that sector, that's really important over the next 12 months, but equally, if not more important, how confident are we in actually monetizing and achieving that return? And confidence, less of a human judgment, but thinking about the opportunities of the potential distribution returns for a sector. So not just a singular spot number, but what's the shape or the context of that return look like? How fat's the tail? How big's the upside? What's this kind of skewness to the middle and the certainty of achieving it? So it's marrying those two aspects, thinking about where to rotate capital to, and we make that decision, populating it with our ongoing, degree of work that we do in research and bottom-up analysis.
So what's the output of this rigorous process right now? Where do you see the opportunity set guiding you?
The process is skewing us to taking less risk versus more. And so we've been upgrading the credit quality of our portfolio. And so what that means is we've been reducing things like high yield corporate bonds, not eliminating them. There's still opportunities within, but scaling it for the opportunity set and the macro landscape appropriately, and taking that capital away from riskier parts of the market and putting it into high quality parts of fixed income that now offer what we think is really attractive relative value. One of those areas in particular is agency pass-through mortgage-backed securities. This is a sector of the market that's AA rated, so it's pari passu with the U.S. government and Treasury. It does not have credit risk. So if a homeowner hands in the keys and defaults on their loan, that's absorbed by the GSE, the government-sponsored entity, and ultimately the government. So as investors in this sector, we're more thinking about the risk to the downside from the duration risk of the asset, the convexity risk of the asset, and are we getting enough option-adjusted spread or credit margin for those inherent risks. And so we think that asset's really cheap relative to its long-term history. And we've been investing very meaningfully in agency mortgages.
Been great to learn with you. Thank you so much, Adam Grotzinger, for your insights.
Thank you.